Within your business, there are three major parts that determine whether or not your business is successful. That's your revenue, your profit, and your cash flow. Each of these parts are directly influenced by what we call drivers, and there are 16 drivers of cash flow. Today, I'm diving deep into the first component, which is your revenue, to show you how the first 5 drivers within your revenue can make you more money or less money. Let's dive in. So the first step is you must generate more cash than what you spend. It is not what you're making in revenue, but what you're really keeping that actually matters most. If your business is constantly spending more cash than what your business is making, then you have a problem and it is time to address it. Now, for example, let's say you're in the HVAC business and you have secured contracts for $1 million, which is great. But once you deduct all of your expenses, like your payroll expenses, equipment costs and maintenance, your rent and utilities, just to name a few, you only have $1,000 left as a profit. Although you may have a very healthy stream of revenue, you're still struggling to stay in business. As the business owner, you must focus on generating consistent, positive cash flow from your business, no matter what business you are in. The focus is not your revenue and not your profit. Now remember, revenue is what you sell, profit is what you sell minus your expenses, and cash flow is what you keep. So what is cash flow? Being an entrepreneur is so hard. There's always a new problem that you need to solve within your business, and it's always rooted to how can I make more money so that I can grow my business. But trust me, I know it's hard because of the many hats that you wear within your business every single day. I've helped countless business owners to solve this very problem with what I call profit, cash flow, and revenue drivers. These 3 key drivers are major to make your business move. This is truly the cheat code to making more money within your business. And if you see this working for you, schedule a call with me today by clicking the link below, within the description, or the comments. See you there. Cash flow is the amount of money that is added or subtracted from last month's bank balance. So essentially, it is your cash flowing in minus your cash flowing out. You want this number, whatever it is, to grow every month. If that's not happening, then the question then becomes, why did you go into business in the first place? As you can see, your cash flow can be positive or it can be negative. So for example, your ending bank account balance for last month was $15,000. And this month's ending bank account balance was right at $15,000. So your cash flow is negative $5,000 because you have $5,000 of more cash going out of your bank account than coming in. Now, if we take the same example and change it just a little, and let's say your ending bank account balance for last month was $15,000. Well, this month's ending bank balance was right at $20,000. Your cash flow is now a positive $5,000. You had $5,000 more in cash to come in this month than what actually went out last month. This is how your business should be performing each and every month. If it is not, you have just identified part of your problem. So now that you know you need to have consistent positive cash flow, the question now is, how do you get it? All of the answers are in your numbers, but most of the time you're not looking at the right numbers. So yes, you have an accountant or a bookkeeper, but you're only paying them to tell you what already happened in the past and file your taxes. They are not equipped to help you find the numbers that drive your profit or even tell you what it is exactly that you need to do to move the needle within your business to get to the next level. This is why you need to have an advisor who specializes in growing businesses to steer you in the right direction, removing the guesswork and adding that strategic decision making. However, by you focusing on a few key numbers, you will start to understand which numbers are preventing your profit and cash leaks the most. Now, before you go and start pulling reports, I want you to understand that not all of the key numbers that you need to pay attention to are in your financial reports, and this is what makes them very confusing. So which numbers do you need to pay attention to? Well, in order to master your cash flow, you need to know the 16 drivers behind it. You need to pay attention to what numbers drive your cash flow, But today we're diving deep into the first 5 drivers of revenue. Now, if you're wondering why we call them drivers, this is because they drive or influence the outcome. So keep in mind that all the drivers are equally important, but the drivers that you need to specifically focus on depends on where you are currently at within your business. Once you, as the CEO of your business, understand your cash flow is off, then you'll be able to take the next steps to fix it. If you're a woman who invests in real estate, looking to get into real estate investing, or you're interested in joining the real estate industry, at Women of GREA, Women of Greater Richmond Real Estate Investors Association, we provide a supportive community where you can make valuable connections and collaborations with like-minded women. Our social networking meetings are the perfect place to start. We meet on the second Wednesday of every other month from 6:30 p.m. to 8 p.m. These sessions are all about building relationships and sharing ideas. For more in-depth learning and opportunities, join our main meetings on the fourth Thursday of every other month from 6:30 p.m. to 8 p.m. These meetings are designed to help you develop real networking skills and boost your confidence in the real estate field. Stay in the know by following us on social media at Women of Greater Richmond, REIA, on Facebook, and that's REIA, R-E-I-A. Women of GREA on Instagram. You'll get updates on all of our events, plus tips and inspirations from fellow members. You can also visit our website at womenofgrea.com for more information and to join our amazing community. See you there. The first driver is your leads. This is the number of your ideal customers that have been made aware of your business through your marketing efforts. So your leads measure how well your marketing dollars are being spent. This also drives revenue because the more leads you have, it will most likely result in more paying customers for your business, which will essentially improve your revenue. So for example, say for instance, your HVAC business posts an ad online via Google Ads or Facebook ads for HVAC services, and a potential customer sees it. Each click on your ads shows a potential customer who has shown interest in your business. But it is only when that potential customer calls your business that they are considered a lead. So here's another way to look at this. Every time your phone rings with a potential customer on the other end inquiring about your HVAC services, it is an opportunity for your business to generate more revenue by showcasing your expertise, building trust, and ultimately securing a new HVAC client for HVAC services. The more leads your business generates, the better your marketing strategy is performing. Each lead that your business receives has the opportunity to become a paying customer, adding to your revenue stream. The second driver, this is your conversion rate. This is the percentage of leads that become your customers. Now, your leads measure your marketing effectiveness, whereas your conversion rate measures your sales effectiveness, meaning how well your sales team is turning potential clients into actual paying customers. For example, let's say your HVAC business had 10 leads last week and your team was able to convert 3 out of those 10 leads into paying customers. Then your conversion rate is 30%. 3 customers divided by 10 leads is 30% of a conversion rate. Now, if your conversion rate is high, let's say you're converting 7 out of 10 leads into paying customers, which is a 70% conversion rate. It means that your team is doing an awesome job at turning your leads into paying customers. But if you have a low conversion rate, it's a huge sign that adjustments need to be made very fast, or you're going to continue to miss out on potential customers. The conversion rate drives your revenue because if you can convert more leads into paying customers, then it will directly improve your revenue. The third driver is your retention rate. This is the percentage of customers who come back to your business each year. So let's say that your HVAC business had 1,000 customers who purchased prior to December 31st of last year. Now, if you were able to get just 5% of those customers to come back and purchase this year, you would have 50 customers that already know, like, and trust you that will spend money with you this year. You take the 1,000 customers and multiply it by 5%, and that is your 50 customers. Your retention rate drives your revenue because you're getting existing customers to purchase again, which improves your revenue. The fourth driver is your purchase frequency rate. This is the number of times that your customer purchases in a year. If you can improve your purchase frequency rate, you can earn more revenue without spending additional money on marketing. So for example, let's say in your HVAC business, if the only thing you did was get additional customers to buy again, you would increase your revenue without having to get new customers. You are directly increasing your profit by getting existing customers to buy again. Not only are you earning more from each customer, but you don't have to spend any additional money on marketing. Your purchase frequency rate drives revenue because the more purchases a customer makes, the more revenue will increase in your business. Just imagine if you were able to increase your purchase frequency rate and your retention rate, you would definitely see a major increase in your revenue. The fifth driver is your average transaction value. This is the average value of every purchase your customer makes. So let's say in your HVAC business, your HVAC customer's average value is $600. By you improving your average transaction value to $700, you will see an increase in revenue without having to get new customers. This drives revenue because the more a customer spends, the more your revenue will increase. So here's the formula. This is how you calculate revenue. You take your leads, which is 500, and multiply it by your conversion rate of 30%. This equals 45 new customers that purchased from you this year. Now we're going to take your existing customers of 200 and multiply it by your retention rate of 10%. This will equal 20 existing customers that purchased from you this year. Then we're going to take your 450 new customers plus your 20 existing customers that purchased from you this year, and that's going to equal your 470 total customers that purchased from you this year. Now we're going to take your total customers that purchased this year, which is 470, and multiply it by your purchase frequency rate, which is 3. This equals 1,410 total sales transactions. Last, we're going to take your total sales transactions, which is 1,410, and multiply it by $700, which is your average transaction value, and this equals $987,000 in revenue. As you can see, this is how you calculate your revenue. Now I'm going to share with you an example to show you what would happen if you wanted to, let's say, increase your revenue. You just need to change one driver. For example, what if your purchase frequency rate was changed to 4 instead of the 3 you had? Your total sales transaction would be 1,880 sales transactions. Now let's say your average transaction value stayed the same of $700, which is what you average per customer. Your total revenue is now $1,316,000. This is a $329,000 increase just by changing one driver. Now, as you can see, by improving one or more of these drivers within your business, you will improve your revenue. Just imagine if you were able to improve all 5 drivers within your business, you would see a dramatic increase in your revenue. So today you learned the first 5 drivers of revenue. They are your leads, conversion rate, retention rate, purchase frequency rate, and your average transaction value. These first 5 drivers drive your revenue. Now remember, revenue is what you sell, profit is what you sell minus your expenses, and cash flow is what you keep. I hope that you learned what the first 5 drivers of revenue are in your business and why it matters to you to make sure that these drivers are performing very well. There is so much more for us to uncover, but by you understanding these key drivers, you will know what's driving your profit in order to move the needle within your business. Please let me know in the comments if these drivers got you to thinking about how you can improve your revenue within your business, and stay tuned for our next episode where we are discussing the additional drivers of your profit. From Everlife Accounting Group, my name is Karina, and thank you for tuning in to another episode of Financial Sense.